Hello and welcome everyone. This is Sunyu Cheyune at IMN, and I would like to thank you for joining us for our next panel discussion, Build for Rent Joint Ventures. We have an excellent group of experts lined up to address this topic, and I'd like to thank them all for joining us. A couple of quick housekeeping items before I introduce the moderator of this session. Please feel free to submit questions throughout the webinar using the Q&A button at the bottom of your screen. You can upvote questions from other people, and popular questions with the most votes will be prioritized and addressed first. While the Q&A will be through Zoom, you'll notice that the Hub platform is still open in your original browser tab. You can communicate with other attendees using the chat function in the Hub page for this session, while also listening to the discussion in Zoom through the second tab. You can either send a message to everyone who's attending this session, or you can privately message someone by clicking on their name in the chat box. Also in Hub, you'll see an evaluation section to evaluate the panel and leave comments on which other topics you would like to see discussed in this area. You must have the session added to your personal Hub schedule in order to evaluate the session. And now, without any further ado, I'd like to hand things over to Mark Peterson, who will be moderating the discussion.
Sorry about that. Thank you. We want to thank IMN for hosting the first virtual SFR conference, since we can't all get together in person these days anywhere. We have a great panel, some noteworthy experts who've all been in the field for a while. I am Mark Peterson. I'm the Director of Build at SFRhub Advisors, and I will let these three gentlemen introduce themselves. Maybe we will start with Mitch and go to Adam and Bruce, if that's okay.
Yeah, absolutely. I'm Mitch Rotta, Director of New Construction at Tricor. We are a construction service provider for the single-family rental space. So operate in both the kind of SFR space on one-off acquisitions, from acquisitions to renovations to lease-up, and then also had the build to rent division that is kind of the full suite of assisting people in kind of we call like our a la carte menu of, whatever needs that you have, whether it's site plans or pro formas, underwriting, development expertise and entitlements, land development, vertical construction, and even bringing lease up. We can kind of assist across the board to kind of help people in every facet of the project.
Thanks,
I'm Adam Wolfson, CIO of Transcendent Investment Management. We are a longtime SFR player and scattered site, and recently moved into the build for rent section in the past 2 years as well.
Thank you, Bruce.
My name is Bruce McNeilage. I'm the co-founder and president of Kinlock Partners. We operate through the Southeast, primarily in Nashville, Atlanta, and South Carolina. I'm fortunate I started doing my build-to-rent business in 2005, and it's great to see, where it has grown and come to, up until today.
Great, thank you, everyone. Why don't we jump kind of right into, at least the title of the panel, and get an overview of what kind of each of you look for, or what you're seeing in kind of build for rent deals or joint ventures. Let's open it up a little bit to just deals between investors and builders, and not focus just on JVs. But Adam, what are you kind of seeing out there? What do you prefer, kind of deals for that kind of thing?
Yeah, I mean, look, there's a number of different formats for joint ventures across the build for rent industry. Everything from folks who have land but not the expertise to build it, coming to groups like ours, asking them or asking us, rather in that case, to help them take a project through not only whatever entitlement, but also through structuring. And they'll either contribute the land or we'll buy into it at some number, some valuation. So we have those types of joint ventures. We have other that are more purely sort of capital, where there's a deal that we've sort of put together from soup to nuts, that requires some additional JV equity, and we will go out and source that from any number of sources. And then finally, there are the joint ventures where you're looking at partnerships with builders that are not just, providing, I guess, development expertise, but also in some cases taking risk along. There are very different structures, who came into the land, when, what value has been added. And so it's very tough to sort of paint with broad strokes to say this is what we're looking at, because it's really situationally dependent.
Right, Bruce, I think Kinloch takes a little more focused approach in how you guys look at deals. Do you mind going over a little of whether you're buying fee build, whether you're buying standing inventory, or how you engage with builders?
Sure. So over the years, I've been a developer and builder, and quite frankly, I'm not looking to take that much risk now. So what we do more is what I call build for rent versus build to rent. So we are structuring it where someone else will buy the land or the lots. We may subordinate our lots to a builder, take them to a bank, and then builds for us. But I'd say 70 or 80% of what we do is not true build to rent, where we're getting entitlement and going through that process. It's doing JVs or financing other builders to deliver us product where we're not taking as much risk.
That's great, Mitch. So from the builder perspective, we kind of have, two versions, even though there's a fair amount of overlap from Bruce and Adam on how they look to structure deals. What is Tricor looking for when you start engaging with a builder, with an investor, of, what would be an optimal kind of situation? Where do you think it's headed, and all of that? Because we know and then we'll eventually roll around to risk, as has been pointed out.
Yeah, absolutely. There's, like Adam and Bruce both said, and we kind of lean towards Adam's strategy a little bit more. It's very situational, and every group is set up in a different way with different expertise. So, our ideal situation is it comes to us, we can come in early in the project, we can assist with underwriting, we can assist with budgets and schedules and phasing diagrams and product selections, design, really kind of control the project from start to finish. And it allows us to kind of cater the product towards, our supply chain, towards our boots on the ground that are seeing single family rentals on a daily basis, and making sure that, the product itself is speaking to the market and what's going to get absorbed. But we've kind of evolved as a company as well, over the course of the build to rent space, from kind of starting as, an idea, and kind of to what it is today. And it's, once again, like Adam said, you got to be very flexible in this space to say, what can you provide? Where are you best suited inside of kind of the full gamut of a project, and leverage those services. So, we look at things of, we can be a developer if a builder comes to us. We can be a builder if a developer comes to us. We can be a developer builder if an investor comes to us. And so we've kind of said we need to stay nimble. We need to be able to kind of cater to the full suite, and it's allowed us to kind of really kind of grasp nationwide a lot of different client bases.
I've noticed from the brokerage perspective, Mitch, over the last, especially 6 months, kind of the sophistication and number of investors looking to enter the build for rent space is different than where it was, say, a year and a half ago. The amount of capital is significantly increasing. A lot of them understand maybe multifamily development and building, but the whole single family building is by and large a mystery to a lot of them now. Are you seeing the same things? Is kind of your model? I know it's been evolving over the last year and a half, but.
Yeah, it's, I think for so long we kind of said, hey, it's a house. We should go to builders for this. That's the product type, that's what they know. And what we're discovering is that, this space in itself is just, from this very start to the very end, is completely different in its own animal. You look at product in a whole different way. You look at the end user in a whole different way. You have to approach municipalities in a whole different way. capital stacks are different. Understanding lease up and handoffs to lease up teams, ongoing maintenance, the materials that you're selecting and how those perform against tenants, moving in and out, every other year. I know Bruce has some very long lasting tenants inside of his spaces, so maybe not as often, but all those considerations are so important to consider. And so, even the apartment guys that jump into this, and we get a lot of those calls recently just based on kind of what multifamily is doing, is, once again, the trade base is different. The developers are different. The designers are different. And so it's right. And you got to really start thinking this as, singular focus on a strategy, rather than just saying, hey, we'll just kind of latch this on to what we've been doing in the past and think it's going to work. It just isn't. It isn't playing out that way.
Yeah, we go on. Sorry,
Mark. I was going to say, look, there have been over the past year and a half a number of different folks from an institutional standpoint that have tried to jump into the space, and I think what you're really seeing is the effect of that on exit at stabilized takedown, depending on the look and feel of the community. The production side, to Mitch's point, is the challenge and the difficulty for, I think, some of those folks to try to wrap their heads around, from a sourcing of land, trades, materials, how you're going to put together a community. But anecdotally, look, a year ago, not even, I remember that we're trading 100 bips wide of multifamily. There's a trade just recently where, we were watching it go off, and now it's trading on par with multi. And I think that, when you're looking at institutional interest, the brokers that had that one marketed, if you talk to them, they'll tell you they had, over 100 new CAs signed for that portfolio on exit, versus where they were to begin with. So I think that there's a ton of institutional interest, but it's mainly on the exit side at a stabilized basis, because it's very, very difficult, I think, for them to get involved in earlier on.
Yeah, we see a lot of that too. And I think that kind of rolls right into, what we can have for the next discussion of kind of risk allocation and risk. And, from our perspective, the ultimate objective is a stabilized, well-designed portfolio of homes. And so every major step back from that the project is, the status it's at, so lease up is a risk, building is a risk, entitlements are a risk, land ownership and acquisition. And I think as you just pointed out, Adam, operating a stabilized portfolio is one thing. Well, let's talk a bit about how each of you allocate the different risk, where you're comfortable participating, kind of from what stage on, what stage you're not comfortable on. And I think, Mitch, your kind of a la carte, let's call it, sheet of services really addresses a lot of that for potential investors and the exit owners of, all right, where do you want to play? Where can you play? And we'll step in.
Yeah, absolutely. And that's kind of the big reason why we set this up, especially, in the initial stages of kind of just being this service provider on the construction side is, the risk typically tends to fall downstream, and that usually lands on the GC in most cases when it comes to the actual project execution. So we said, well, to mitigate that risk, we need to be, once again, in the project early, contracted early to be able to work with these owners and developers to say that, hey, let's build a budget. Let's get our product identified. Let's get our specs identified. Let's really start hammering in on the details of what it takes to get these projects off the ground. And then understand what's going on in the marketplace. I mean, we're seeing lumber right now spiking 80, 90%. The whole supply chain as a whole. I mean, the focus is always on lumber, but we're talking drywall, concrete, appliances, hardware on cabinets. Every nut and bolt that goes into a house right now is kind of in disarray. I think a lot of that will get flushed out of it in the next 6 to 9 months as kind of everyone gets back to work. But, how do you adjust for that type of situation? And we're in a unique one right now, but it also means that as risk continues to shift, you know, people are going to start saying either I'm not willing to take it, even builders saying that, or it's let's share in risk, or if we are going to be completely at risk, then, you know, there's a premium to that type of approach, and it tends to make these projects, you know, pretty difficult to pencil when you layer on top of all that different contingency.
Yeah.
So Mark, I think Mitch brings up a good point. A lot of builders are starting to see the raw materials increase, and they haven't planned for that. We can't get COs if you don't have a refrigerator. Imagine you're looking for refrigerators and you can't get COs. And so I think that's why a lot of builders are looking to do joint ventures with people like us, because it removes the risk. It's a natural out. They are doing things primarily at fixed expenses, other than maybe some things, raw materials and whatnot, and labor. Hopefully you'll lock into those for 60 or 90 days. But their cost of capital as far as paying for a construction loan is lessened. And the other thing we're doing that is different, we're borrowing the money for acquisition from the same bank that's lending the money to the home builder. So that bank has money out on the street. It just shifts from the builder to us. And we're getting very favorable terms on the long-term financing. And then the builder's getting real good terms on their construction loans.
Thanks, Bruce. Adam, how's Transident kind of, you know, you guys can play early in the process or you'll acquire later on. Kind of where's the sweet spot, and how do you address, or not you, but Transident address some of, you know, the concerns that both Bruce and Mitch brought up? And I know when we've looked, increase in cost has always been a concern of builders. I just don't think anyone anticipated a 90% increase in lumber over 3 months as part of that level of risk. So how are you seeing that addressed?
Well, look, we got our start buying single family homes for rent, and our strategy evolved over time to buying scattered site, new product constructed by mainly publicly traded builders. So we've been doing this sort of scattered build for rent since 2015 or so, and it's more recently where we've come into the purpose-built, fully amenitized communities, and along that there's a risk spectrum, right? So when you're buying a home that a builder was intending to sell retail, not expecting the same level of return you are when you had to go out and get land, get your permits, bring in capital, and take a 3-year process to build. You're coming in many cases in the last 30 days that a builder owns that particular home. And so there is relatively little risk in doing that. It's really a core plus execution, right? And so you don't need to be getting development level returns, assuming that you can align with capital that can do a core plus risk profile deal, which we've been able to. On the flip side of that, when we are going out and sourcing land and bringing it in, we are expecting higher level returns because, as I was mentioning, you're likely 2 to 3 years before you even take possession of your first home at some point. And so for an investor to come and join you in that deal, you need to be offering more than a core plus or even value add return in that case. And so when we look at holistically our entire platform, we sort of look at it as 2 different flavors of build for rent, and we can sort of come in between those 2 risk return profiles and saying, okay, well, we can get immediate cash flow or relatively quick cash flow when buying existing standing inventory. And on the other side, you're not going to get cash flows for some period of time. And so by being able to buy standing inventory on existing inventory, you're going to get some sort of a blended return, which allows for earlier cash flow. So that's how we're addressing the 2 different sides of the risk return spectrum, by sort of blending them together and saying, okay, here's some cash flow early on to take some risk off the table, and your development level returns are back-ended.
That's great. How about if we jump to one of the questions from the audience? And Bruce, I think this one is mostly for you, but Adam and Mitch, feel free to jump in afterwards if you want. An attendee is asking for clarification between the difference between build to rent and build for rent.
I would say the difference is just taking less risk. They're both going to be purpose-built assets, but build for rent is basically a purpose-built house, but you're taking the risk and maybe spreading it or putting it on someone else's shoulders. Where build to rent, in my opinion, is going from the first part of the phase. It might be entitlement or buying the dirt or pad-ready lots, and then following it through. One has less risk than the other. Certainly, I end up paying more for a house by taking less risk. But in the overall scheme of things, I can do my numbers and I can hit my pro formas on a build for rent type of program, whereas a build to rent, I might have some variables. And if I hit the mark or I miss the mark, that's going to hurt both my returns and my pro forma going forward.
I think Mitch might argue the point that there's less risk in one model. It's just a transfer of risk.
Absolutely, and that's the nature of real estate, right? I mean, it's this is kind of what we all signed up for. Is it's a risky game. I think the overarching theme of build to rent as a whole is a reduction in risk compared to most other real estate classes as a whole, and I think that's why it's attractive to a lot of people right now. But at the end of the day, it's you still got to go through a city. You still got to get designs. You still got to put shovels in the dirt and run utilities and pave streets and build houses, and so it falls in line with everything. There's just some unique characteristics that help it and kind of make it more attractive than your typical residential community, just because of kind of the way you can go about the construction process.
Well, and Mitch, I'm sure you've seen where a municipality all of a sudden wants a bridge, or they want a sidewalk, or they want a park, and they shake you down for 50 or 100 grand.
Exactly.
It's not in your pro forma, but you have to build that in your pro forma. And I call it the BS part of the portfolio or part of the pro forma. You just throw a couple $100 grand at things, just knowing there's going to be an issue like that somehow. And I have to be honest with you, I don't think I've ever been in a situation where something like that hasn't been asked of you right at the final stage of approval.
Exactly. Yeah. We'll give you this approval if, and that's that's when the dollar signs.
Here's my wallet.
Start rolling.
The approval.
Yeah. Why don't we take a look at kind of the financing and capital stack? And so maybe we'll move farther into or earlier in the process than buying standing inventory, just because that'd be fairly cut and dry from the investor perspective and the builder's already done it. So let's assume, maybe it's not acquiring the land, but somewhere between raw land and starting horizontal development or vertical construction. Adam, in kind of what you see out there, who do you see as responsible for different aspects? And you can take it from whatever stage of development prior to a finished house you want to talk about.
Yeah, I mean, look, I think to your point, it is fairly straightforward and when talking about standing inventory, rather, you're really just sort of buying houses. It's equity and debt, 70% debt, 30% equity, and depending on your structure with your JV, that's probably a 90-10 or a 95-5 structure. When you're looking at development, fundamental structure necessarily changes. I think you may get, depending on your builder relationship and what sort of financing they bring to the table or otherwise, you may climb a little bit higher in the cap stack in terms of what you, I guess, traditionally call construction financing, right? And so if you're able to Bruce's point, when the lender knows that they have a guaranteed exit on the back end, the builder's lender that is, they may feel a little bit more comfortable getting to higher leverage points. And so that likely reduces the amount of equity you need up front. Now, having said that, if you're not aligned with that same builder's lender on the back end, you may need additional equity when you're coming to the back end of your project, when it's time to actually acquire the units from the builder partner, right? And so I think that a multifamily execution is different in that regard because you kind of know what your equity requirements are the day you start. Whereas in build for rent, unless your lender is the exact same lender that the builder is using, you may or may not require more equity at the tail end of that.
Well, Adam, I think that's a good point. We're also getting better LTV, not LTC, because the bank has already appraised the asset as the as-built, and so they're comfortable loaning a higher percentage because they know what they're loaning money on, and that gives us the ability to use more leverage and use less equity.
Absolutely.
And I think, this is probably the biggest hurdle right now inside of build to rent as a whole is just the total capital stack. That's got to be assembled for these things that, it's a lot of traditional players inside the space right now, especially in the private equity world that are jumping into this and, putting it up against other asset classes, once again, is kind of a tough situation where it's not multifamily, it's not single family residential for sale. It's its own beast. So you have to, once again, look at it through a different lens. So how does GPLP play into this? Who are A&D on this? Can they roll into construction? Can they be that permanent financing or a bridge loan? And kind of assembling all of that. And once again, it's decisions that need to be made super early on in the process. And, to everyone's point up here, it could be 2 years before you may even need to bring in some of this equity, especially if you're deferring, land takedowns and entitlement plays with a land seller. So it's that there's tons of different pieces that are moving, and capital is for sure, obviously a major player that dictates how and what you go about on getting a project off the ground.
Yeah, and I'd add to that, even just removing the debt component and looking purely at the equity, which is of course a function of the debt. There are multiple different points in equity, right? So. And not all of them are institutionally friendly because they're not always a large enough check for an institution to come in. So if you have a much lower equity requirement up front because your LTV or TC is substantially higher than one would expect, and you can finance it balance sheet, you have to ask yourself, why bring an institutional partner that early on, unless you're going to need that capital towards the back end. And then there are some other institutional players that will come in, towards the tail end, maybe at X% stabilization, for example, at a markup in basis and take you forward or take you out. And so you really, as a builder here, as a developer, you have to understand, what is your goal? Are you looking to hold these units and exit? Hold these units or exit these units upon stabilization, or is there some hybrid structure where you can allow an investor to come in sort of in between? And I think that it's not just LTV, LTC. It's where and how do you want, and why, frankly, do you want a partner if you're bringing in equity?
That's all. Like if you summarize all of this, it's creativity, right? These deals need to have creativity in them. They are not typical in any sort of way. So you gotta do everything you possibly can to kind of look at site plans different, look at capital stacks different, look at designs differently, look at product selections differently. It's the whole suite. And why I think joint ventures are so important in this is that there's specific expertise at each one of these steps, and so leveraging those expertise in a certain way is a huge benefit for especially something that's so early on in its infancy of taking off. You got to come to the right people with the right resources and knowledge to kind of educate you on those pieces to, ultimately, once again, lower risk in this whole thing.
Yeah, we view build for rent as more or less about where multifamily was in let's say the mid 80s, before Wall Street got involved in it. And so now if you want to do a multifamily deal, you know who the lenders are, you know who the equity is, buyers are, everything is pretty much predetermined. Whereas, the three of you are out there on the wild frontier, so to speak, of blazing a path through to get these deals done. Are there 2 or 3 kind of factors or points that you find are really the key points to get a deal between, say, an investor and the builder worked out?
I'll take the first shot at that, I guess. I'd say number one that we're seeing is land basis. And so, where are you sitting on a density standpoint, and how does that translate to your land basis on a per unit level? That's a major factor, and it's usually typically the first big tranche of cash that you got to pull, and usually is the most expensive. So, maximizing your density on every single site is a huge factor to consider in these things. And it's why townhomes and duplexes, and the horizontal apartments got pulled into this, is because it's a way to better use land, and still kind of get the right purpose out of it. Two is rents. You really have to understand the marketplace, leverage some of the great resources out there, and property management firms and third-party market studies, to help you, understand the marketplace as a whole and really get comfortable with, where those are at. And then third is kind of those like weird specifics, whether it's property taxes or HOAs, and the operating expenses, because you could add in a couple, $100,000 even in a slush fund into a project and contingency and use it up, but you miss your mark on property taxes and the entire thing is blowing out the water. So I'd say those are kind of the three highlights, and whether you're building these things to sell them off or building them to hold them, you still have to understand the entire process, because whether you build it to a certain mark, it doesn't mean that someone's going to be there on the takeout if you're, sitting all in on these things at, $285, $300K a door. But, it doesn't mean that it's going to work, and the rents in the area are going to stabilize at that.
Mark, for us to get the maximum rent, we want the largest number of bedrooms. We've found that the bedroom count is very important. The square footage is not important. So if you do a 2,000 square foot house, sticks and bricks, it's going to cost X. I can make that a 3.2, a 4.2. We've even done 5.3s at just under 2,000 square feet. And incrementally, I get about $100 to $150 more per bedroom. It doesn't cost me anything more, but I'm monetizing that, just by having bedrooms. I don't do 9x9 bedrooms, but Mitch, I'm sure you've seen 9x9 or 10x10. I think the lowest we'll go is 13x11 or 12x12. But as long as it has a closet and a door, you can really maximize revenue by taking your sticks and bricks and engineering the house in a way to get the maximum amount of rent based on what you have in the house.
Yeah, look, I think that Mitch and Bruce hit the high points, but to your question as to how to get it to work, look, I think their points rather were how you get it to pencil from an economics perspective. How do you get an investor comfortable with the structure is a different story. And I think that's more one of risk, right? And so the investor is going to want to look through your structure with your builder, and understand is there a GMP in place, a guaranteed maximum price bid? Is there a cost savings element built into that? What structures do you have from your builder that you're going to get units when you say you're going to get units? And so there's making it pencil from a financial standpoint, and then there's making someone comfortable putting capital into it alongside of you.
Yeah, and I think to kind of the points that were made, one of the things we see, other than, few and definitely not including Bruce or Adam, is a near complete lack of understanding of what it is Mitch and his compatriots do, that is develop land and build a house. A house doesn't magically plop down fully amenitized. So the more someone understands that, even to buy, anything other than standing inventory, they have to get comfortable understanding the build and construction process.
And that's a great point, Mark. I'd just expand this a little bit more, but it's, as this gets more sophisticated and there's more sophisticated capital, the expectations of what you provide up front are going to get bigger and bigger, and they're going to need to be more detailed. There's going to need to be more backup. And, it's great to see big capital come in, but it also means that, you don't have your shit together. It can be an ugly road pretty quickly for you. And so once again, using the right people in right situations is key.
Yeah. This isn't so much of a JV or a deal question from the audience, but kind of from a functionality, I guess, is do the build for rent communities have clubhouse, office space, or is it just kind of what is the amenity package that you're seeing? And I would, from our perspective, it's based on the size of the community, but
yeah, there's for us, we build all of our purpose-built communities with amenities, and so that depending on the size of the community, it will sort of I guess dictate the size of the amenity center. But it's always going to include a fitness facility, a multi-purpose room, yoga studio, pool, outdoor playground equipment for children. We really are looking at sort of the way a multifamily community would amenitize, and we're saying we're really dramatically we're not that dramatically different from a multifamily community. We should be offering similar amenities. We are taking steps to offer additional amenities on top of that, health and wellness focused branding, et cetera. But that's I think where we're taking one step beyond. There are some folks who are building build for rent communities that without any amenities, and we've always sort of scratched our head. They're not easy to make pencil, but you add yourself another layer, I think, of renter who maybe was coming out of, say, a garden style multi in a 3-bedroom and now feels a little bit more comfortable taking that next step into a larger home because it looks and feels and smells a little bit more like what they were used to in terms of institutional programming with amenities.
So Mark, I'm a little different. We do like 25 to 75 house developments. So I jokingly tell people the amenity is a sidewalk and maybe a gazebo. I'd like to amenitize a 50 house community, but I can't. But what we try to do is build connectivity where we are next door to an elementary school. Our latest project, every single house is within 100 yards of the elementary school, and we built a sidewalk so everybody can see their kids walk to school. And for us, it's more positioning in what's important. We just don't have the money, nor are our deals big enough to afford or being able to justify an amenity.
That's it right there, right? It's who are you trying to attract, and what size of community are you? If you're attracting the renters that are coming from multifamily and need to feel like they have to have a pool and fitness center, but they're getting the small backyard for the dog kind of thing, then it's perfect, and you can provide that. If it's my family is growing and I want to be in a better school district, do I even need a pool? I'm just looking for a house at this point. And so I think, focusing and knowing who your renter is ultimately is kind of the first question. And that kind of then trickles down to understanding what you need to provide to make sure that you're kind of appeasing them and the rents that you're asking for.
Yeah, and to that end, to that point rather, most of our communities, our first one's 184 units, our second one is north of 200 units, and most of the communities we're looking at are in that sort of range where I think minimum right now. I think the lowest one we're looking at is about 120 units, and so to Bruce's point, it's really almost impossible to get something to pencil from an economic standpoint with $1 million plus, $1.5 million plus in amenities. When you don't have enough units to do it. And so I think that is really a determining factor as to whether you're going to amenitize or not, or how you're going to amenitize rather.
Yeah, that's what we find. And, it varies by location. We work with some investors who basically want to mirror 225, 275 minimum number of units. That's a pretty rarefied group. You get down to it. There's only so many groups who have a spare 80 million lying around or access to it to go by one community. And I think, we have about a minute before we have to wrap up. If there's anything real quick, any of the three of you want to leave the audience with, or otherwise, thank you all for an excellent discussion on JVs and deals on build for rent.
I would just say be careful of how much money you're borrowing and make sure you hit the pro forma, because if you build something or develop something, you can go over budget real easy, and that changes the whole deal, whether it's an investor, a builder, or really yourself.
Take it easy on your GCs.
Get strong GMPs with your GC.
Yeah. Shift your risk. Shift your risk.
I think you guys might have a trouble working together, but thank you everyone, and thank you, IMN.
Thanks, guys.
Thank you.
Appreciate it, Mark.
Thank you so much to our esteemed panelists. I hope everyone found the discussion to be of value. I'd like to extend a thank you to Mark Peterson, Adam Wolfson, Bruce McNeilage, and Mitch Rotta for the work they put into this and for sharing with us their time and their expertise. Please take the next 15 minutes to connect with your industry peers during our afternoon networking break by visiting the exhibit hall and exploring the virtual booths on display. And be sure to fill out an evaluation for this session in Hub. As a reminder, this session needs to be added to your schedule in Hub for you to be able to evaluate it. Also, we'll be sending out a full conference evaluation survey before the end of this week, and we would very much value your thoughts and experience of our first large-scale virtual event to help us shape things as we move forward. Thank you so much for joining us today, and please continue to enjoy the Single Family Rental Virtual Conference.